Hey, Buffalo Bullion, how you doing, my friend? Glad you could make it. Sound coming in okay for you guys so far? Max, how you doing? Buffalo Bullion, yeah. Glad you're here. Buffalo Bullion are some of my favorite types of bullion, whether it's the gold Buffalo or Buffalo Realms. How you doing, Sean? Bobby, how you doing? Rob P, how you doing? Glad you guys could make it this evening or this morning, wherever you guys might be. Max, sound okay? Thanks, Mac. Appreciate it. Aaron, thank you. Appreciate it. Music is intense. Yeah. I guess it can be, huh? Webby, how you doing? MLK holiday. That's right, Martin Luther King holiday in the States. Hello again, and welcome to another edition of Silver Bullion Television, SBTV. Glad you guys could be here. I'm your host, Patrick Vieira, and again, I know it's either late for you guys in the States or getting up close to being late in the evening or morning for you in Asia. So again, I appreciate you making time to be here, and still trying to get over this late cold. So apologize for the voice that is kind of different. I guess is a good way to put it. But glad you guys could be here. Rob P, Weme, Buffalo Bullion, Orlando, Florida. Great. Aaron, Rob P, Richard Reed. What's up, Richard Reed? First time I think I've seen your name. Welcome aboard. Rob P, Nevada. Good place. Nevada's a good state. Had a chance to go there for the first time back in 2017, I think it was. I like it there. Richard Reed, go Niners. Okay, so I guess we got some Niners and I guess what KC fans in the house. I don't think the Titans. I don't think they made it today, right? Annette, Middle Tennessee here. How you doing? Nameless. Uh, okay, we'll see how things go. How you doing, Nameless? Paul, Silver Patriot. How you guys doing? So again, I hope everyone is doing fine. And again, if you are new to this channel or if you have not already done so, please do subscribe. Click on the bell to be notified on new updates and give us a thumbs up if you like what we do. Again, we truly do appreciate the support that you give us. And as always, you can find us on social media. Our website is silverbullion.com.sg. Again, SG because we are over in Singapore. Facebook, Silver Bullion SG. Twitter, you can find us at Silver Bullion PL for private limited. And the audio versions you can find on bit.ly, bit.ly/ SBTV iTunes or SBTV Spotify. And if you have Telegram on your mobile phone, do join us, or even on your desktop, join our group, Crisis Tracker, where we go over some news events, economic or otherwise. And it's always good to stay in touch and see what's going on, especially if all of us can really see what's going on, then the more of us we have to inform each other, and then we can make our best decisions based on the best information that we can find out there. So again, we're glad that you join us. We're glad for this community, and again, let's just make it something that is a positive thing for each of us. So again, thank you all for being here. um James Richter, how you doing? Paul Eldon, how you doing, Paul? Good day from Australia. Glad you could be here. um James, you're over in Minnesota tundra. Yeah, oh, I'm getting cold just thinking about that, my friend. Lowell Geds, hello from Cape Breton Island. I think it's the first time I've seen your name as well. So again, thank you for being here. Really do appreciate it. So as always, first thing I want to do is head on over and check out the gold and silver price. It's Monday morning here in Asia, 10 o'clock here in Singapore, or 10:03 a.m. here in Singapore. We will be closed January 24th for Chinese New Year Eve, and we're closed on the 25th. This should be a Friday and Saturday I believe. So just a heads up in case you folks are trying to get in touch with us and nobody responds during those 2 days. Okay, so we're seeing silver 1805 per ounce, and we're seeing gold at 1558. Not much change since Friday. Both metals are hanging on to where they were on Friday. And again, on the website, do download this investor kit. It's a free investor kit. A lot of good information in there. And if you haven't already done so, you go ahead and sign up for our Star Storage account. It doesn't cost anything. It doesn't cost anything to maintain. And we do send out newsletters from time to time when you do sign up. And a lot of good information again if you do that. And don't forget, our peer-to-peer program where I think we are just about the only place where when you have your gold and silver stored with us, your platinum, palladium, cobalt, nickel, you can actually use it as collateral to go ahead and take out a loan. And if you got extra cash laying around, you can also sign up for an account and you can go ahead and create lending offers and loan people who are looking to borrow money. This is our peer-to-peer program. If you got more questions about that, let us know. And silver to gold ratio, we're looking at about 86 still, 85.9. So definitely a time to be buying silver. Gold is good, always, gold is always good, but with that ratio being up so high at 86 roughly, let's just call it 86, definitely a good time to be getting silver as silver is undervalued for sure compared to gold. So looking at some of your comments there, um, Bobby Jones, communist state of New Jersey. Wow, what's going on there? Okay. Uh, James Richter, yeah, small dip, nothing too exciting yet, but it's okay. It's still a good time to accumulate your insurance policy slash investment. So there's still some good things to be said with that. Let's see. Nameless, what's the smallest market? Well, from what I'm not in the broad. Uh, let's just say for me, the areas that I know, silver is the smallest that I know that I'm in. It's the smallest market for sure. I don't want to give a um, statement for all markets across the board, but for the areas that I'm in, silver definitely smallest market. Paul Eldon, going to buy my first 100-ounce silver. Hey, hey, good on you, my man. Paul Eldon. Gotta take a picture of it. Let us know next time, huh? What you got or what you're gonna get anyway. Big day in Virginia. Prayers for our Patriots. Dino D. Yeah, we need some prayers over in Hawaii also. I think we had some guy set some houses on fire and he ended up shooting and killing, I think, two police officers. So you got some prayers. Be sure to send them their way as well. Platinum is running. Absolutely, Greg. Let's see. Not sure. Okay, Paul. Okay, so glad again that all you guys are here, and again, we this seems to be an ongoing thing as well, where we're going to go ahead and take a look at the Fed balance sheet. We do know it is growing, and we are getting close to where we were before all of this tapering and all of these things, but we're not that far away. 4.4, just call it 4.5, and we're already at 4.1. I would suspect somewhere by March we're going to be right about there, if not earlier, the way things are going with the Fed and of course the repo market has really been pretty heavy lately. I mean, what's been going on there is amazing. It should be plastered 24 hours all over every news channel. Friday the 17th, last week, when we take a look at the repo market, reverse repo. Fed did another one, a pretty high one, 16 billion. Usually these reverse repos should be, let's say, 1 billion or below typically, but here we are at 16. So something again is going on. This is very high for a reverse repo. I would say it's significantly high. Repo market, again, treasuries. Fed took in 10 billion, but this is the number I'm looking at. 40 billion. We've been talking about this. The MBS or mortgage-backed securities, they are running wild in the repo market right now. 40 billion, but you're not hearing about this anywhere on the news for some reason. They don't see it significant to cover. So these are typically more normal numbers for reverse repo with the Fed. Again, one or below. So that's pretty typical. But again, mortgage back 21 billion. That's quite a bit. It's well, it's over the what they're taking in as treasuries. They're taking in mortgage backed securities. Again, higher than treasuries. Um, 20 billion, 14 billion. I'm particularly just paying attention to treasury and mortgage back, these two there. Those are the ones that I'm really looking at. So again, below one, which is good. This is the reverse repo, so it's not too bad. We come again, mortgage back 21 billion. Again, something really, really, really is going on with the mortgage backed. And I want to go ahead and take a look at my Twitter feed. Let me go to some of the things that I've bookmarked. So yeah, three wood electric car is coming out. I'll probably get into that in the market update. So that's pretty cool. Peter Schiff lost his Bitcoin. Sorry, I guess I shouldn't be laughing, but Peter Schiff lost his Bitcoin. So he's needless to say, he's not too happy about that. So Peter Schiff, I just lost all the Bitcoin I've ever owned. His wallet got corrupted and his passwords no longer valid. Uh, Simon Mikhailovich, counter risk in living color. UBS refused to pay 9 kg of gold from a gold account to a German client unless he proves that the gold had been declared to German tax authorities. Okay, so I just want to go down a bit and show you one thing on um, that mortgage, that MBS. Um, this we'll talk about as well later on, where hedge funds could make a potential Fed repo market fix hard. Well, we'll get into that a bit later. So this is coming from Randy Woodward, where he says the expanded credit MBS sector posted a hefty 130.3% jump in new issuance during 2019. Expanded credit is so much nicer than saying subprime. And this is what we've been talking about in the repo market, where, basically you come down to this last portion here, where he says, um, ECM compromises an array of products, including loans that don't meet the qualified mortgage test, non prime loans, and mortgages originated with non traditional underwriting. So these are the things that we've been talking about when we go ahead and take a look at the repo market, where we've been seeing these huge numbers as far as mortgage backed. So again, 24 billion in mortgage backed securities compared to 22 billion in treasury backed securities, or treasury. Yeah, there you go. Sorry about that. So this was last week, basically, where again the MBS, the mortgage backed securities, just went wild. 30 billion again compared to 30 billion in treasury. So again, we're truly seeing something going on with this market that isn't really being brought forward, but eyes are starting to notice it. And again, if you've been with us, you've been noticing it as well. That repo market, you know, definitely something's going on there, and we got to find out what it is. And in fact, the Fed recently came out and said that they do plan to continue repo offerings into February. This is coming out from Reuters. It's just a short article where the Federal Reserve Bank of New York last week said it will continue to offer operations in the market for repurchase agreements, or repo, into at least mid February. Central bank will slightly reduce the maximum on term operations, which lasts 2 weeks, to 30 billion from a previous cap of 35. The Fed said it will also continue purchasing 60 billion a month in short-term treasury bills, keeping the same pace set in mid-October when it began growing the balance sheet to permanently increase the level of reserves in the banking system. So I just want to go ahead and take a look at your comments. Um, Peter has a place in Puerto Rico for taxes. Yeah, apparently what I'm hearing is Puerto Rico's a pretty good place as far as um taxes. Not as uh the taxes are a bit less there, I guess. I'm trying to search for the proper word, but it's more friendlier, Puerto Rico anyway, when it comes to taxes. Um, okay, Jesse, how you doing, my friend? Let's see. Always, Tanis Christie, love to hear always on what you speak. Thanks for being. You're welcome, Tanis. We try, we just try to keep people informed, and as much as possible, we'd like for each of you to come to your own conclusions. Um, naturally, I have mine as well. I think you guys can read right through me what I'm thinking, but it's all about information and getting the right information sometimes. Well, actually, all the time. Let's see. Stan, Skeleton, Randy, Rush Hour. Hope these guys at the Fed stay on the wagon. Well, we'll see what's going to happen with that wagon because, I mean, it looks like the Fed wagon, those wheels, they're going to come off at some point. And, with all this money being supposedly pushed around, or cheap anyway, cheap money, the world's largest hedge fund sees gold rising to 2,000. And he says there's so much boiling conflict. Bridgewater's co chief investment officer Greg Jensen told the Financial Times that gold prices could rally to 2,000 an ounce. The manager from the world's biggest hedge fund cited increased income inequality in the U.S. and rising tensions with China and Iran as uncertainties that will prompt more safe haven buying. Jensen also believes the Federal Reserve would let inflation run hot for a while. Uh, Mr. Jensen, that's if the Fed can get it. I think they failed, and we're going to get into that a bit later. Um, Fed, he lets inflation run hot for a while, which also creates an environment for higher gold prices. Spot gold now trades at about 1551. This is when the article was written last week. I don't think, as I mentioned, that I don't think the Fed's gonna get that inflation, but I think whether they get it or not, I think people are going to just simply wake up to the fact that something's definitely wrong with the economy, and it's time to get into some safe haven assets like gold and silver. So he goes on to say, gold prices briefly topped 1,600, could rally to 2,000 an ounce amid heightened political risks. The manager from the world's biggest hedge fund cited increased income inequality. Okay, we got through that part. There's so much boiling conflict, he says. People should be prepared for a much wider range of potentially more volatile set of circumstances that we are mostly accustomed to. Jensen believes the Federal Reserve would let inflation run hot for a while, and I think he's correct with that. If the Fed gets that inflation, they're going to let it run, and which could also create an environment for higher gold prices as investors tend to use the precious metals as a hedge against inflationary forces. Going down a bit, the Federal Reserve cut interest rates for three times last year to combat a slowing economy. Jensen said it's possible the central bank could slash rates to zero this year to avoid a recession and disinflationary pressures. So he's saying some pretty severe things, and all of this, it does seem to start, sound a bit crazy. And here we go, another article where this is nuts. One strategist explains why he just reduced risk by selling Apple, Microsoft, and more. And he says, what happens in the stock market when price acceleration goes vertical, which we know it has. We're having all time highs seemingly almost every day or twice a week. And when this acceleration goes vertical and investor complacency reaches extreme levels, typically bad things, according to Lance Roberts, chief investment strategist at RIA Advisors. And we're there now. This is nuts, his team said Friday when trying to wrap their brains around what's next. Roberts explains he's reassessing the overall portfolio risk for his clients in the face of a bull market that just keeps chugging along. So, what's nuts about it? The way Robert sees it, things are overbought and extended, and it's a complacent market. It's heading toward a day of reckoning, and he used a tandem of charts to illustrate the excess. First chart, the near vertical price acceleration. So we're seeing that. Actually, let me go down a bit. Um, Put to call ratio, which shows the number of put options being bought on the S&P versus the number of call options now hitting historical levels and showing an increasing appetite for risk, probably Fed induced risk. People are reacting to the Fed, which is not a true representation of the market anymore. While none of this means the market will crash, Robert said it does suggest the risk reward ratio is not in favor of the bulls short term. It's growing increasingly clear to Mr. Roberts that the global stock markets are in the process of making a spectacular move driven by global liquidity that may even compare to the advances that culminated in the seminal markets, tops in the fall of 87 and spring of 2000. Robert says investors are getting swept up with FOMO and ramping up their risk despite the fact that every valuation measures out there is topping out at extreme levels. Yes, this is nuts. Sorry. Yes, this is nuts. So Mr. Roberts is, I guess, basically giving a warning or his analysis on the markets that it's overheated. Markets have really overheated already. Fed induced, of course. Comments, Polynesian Pip, how you doing, my man? Let's see. Less silver in earth than gold, Susan Klein. On surface, absolutely, absolutely. Um, Less silver than gold. I think it's still 5 to 1 or something like that. Five times less silver than gold on the surface. Anyway, that is. Let's see. Stan Skeleton Randy Fresh Hour. Do we have the feeling this Iran Lebanon uprising is investor driven? If to define the markets, basically, that's a good question. That's a good question. Um, I think I'd like to look into that a bit more before comment on that one. But that's a really great question. Dino D. Peter Schiff, great teacher of free markets. Peter Schiff, yeah, he's one of those guys. Either you like him or you don't like him, but his he does know the markets. He does know the economy. His claim to fame, one of his claims to fame, was predicting the, the housing crash or the market crash, 2007, 2008. And the thing that's been an anchor for Peter right now is he's been saying this the collapse would happen for quite a while, and I guess the downside when people say these things is the longer it takes, the less believers you have. Even though the fundamentals are still there, less and less people start to believe you. But the trade off is more and more people also start to wake up. So there's a little bit of good and a little bit of bad in that. But I think I think he's a good guy, even though he won't come on our show every time we ask him for an interview. But it's okay. We still like you, Peter. Maybe one day, one day we'll get you. Peter's ultimate gold bug. Yes, he is. Momentum buying. Absolutely, Paulin. Thomas Toops, how you doing? And let's see. Okay, so we'll let's see. Hey Bart, no more Monday, Tuesday streams. Not sure what you mean. If it's for us, we still try to get in Sunday night Eastern, Monday morning, Asia. Susan Klein, do you see silver hitting $77 per ounce? Um, that's a good question. I don't think it's impossible. I mean, I think if you look at the money printing and if you go by the standard where guys say if you have to account for if gold has to account for all the money printing, silver is going to be on steroids and whatnot, this and that. I do think you're going to see at least the ratio come down. I do think that ratio right now in the 80s that definitely will come down, and that will turn your silver finally into, I shouldn't say finally, but that's going to really help the silver to be that investment that you had hoped it to be, relative to gold. With the price, if that's what you mean, 77 per ounce, you know I it, my heart says yes, absolutely. But my eyes, my mind, the way I see things manipulated, it's tough to say. But I do know that the purchasing power of silver is going to be there. The way it fights off inflation, that's going to be there. Everything else, all those fundamentals are going to be there. For me, maybe that's why the price of silver. I have a hard time trying to go with that because I know that there's so much more than just that price aspect of it, especially when it comes to the wealth protection part of it. So, um, 77, I'm hard to say because I'm really more in the wealth protection side of it and understanding that aspect because at 77 we just don't know how the world's going to be at that point. Even if it's 100, like they say, even if gold is 5,000, 10,000, how's the world going to be at that point? So there's a lot of factors that do go into it. And geopolitically, anyway, we had I think a pretty stunning statement coming from the UK where they say the UK is abandoning its alliance with President Trump as the United States withdraws from its leadership around the world. Let's see. UK is threatening to tear up its defense alliance with the US. This is pretty significant coming from the UK. These two guys are old buddy, old pals, right? They've been around. They've been around the block with each other a few times, good friends, hand in hand and whatnot. But UK is threatening to tear up its defense alliance with the US after Trump's Iran crisis triggered a rupture between the two countries. UK Defense Secretary Ben Wallace told the Sunday Times that the UK was looking to forge stronger alliances with other international partners that shared its priorities. He said the US under Trump risked withdrawing from its global leadership role. Wallace also said Trump threatened to tear up the US's intelligence sharing relationship with the UK. So I find this pretty severe, and a lot of it has to do with his order, President Trump's order to assassinate uh, Sol- Soleimani, and has triggered major rupture between the U.S. and its historically closest ally. And in a remarkably outspoken comment, UK Defense Secretary Ben Wallace said in an interview published last week that Trump's isolationist foreign policy stance had prompted the UK to look for alternative allies. I mean, it's a pretty telling article. Let me copy that for you. If you guys want, you can go ahead and I'll paste it here, and then you can go ahead and take a look at that on your own. But coming from the UK, I found that it is a bit troublesome. UK is going through their own issues with Brexit and whatnot, and I don't know if that's part of it where they need to form new alliances. But again, coming from the UK, totally unexpected. So we're gonna have to again see how these things, as I continually say, how these things unfold. So keep an eye on that one. Let's see. Let me just take a look at some of the comments. Sorry about that. Polynesian Pip, stack it and forget about it. Live your life. Absolutely, that's one of the good things about silver and gold. You stack it. You got that insurance, and you actually do sleep a little bit better. And that, especially if you understand that it's more than just price, which is the key. You got on. It's good to understand that silver and gold. Their wealth protection types of vehicles. They're an insurance type of vehicle. They're hedge. Call it a hedge against central banks if you want to, but you will sleep a little bit better. But it's like I say, it's more than just price. Okay, and so speaking about Donald Trump, I don't know if you folks had the chance to see the ad that he released recently. I came across it on Twitter. It's a pretty cool ad. Whether you like the guy or not, there were some pretty what I say subliminal. There were some subliminal messages going on in the ad that he gave, especially three parts where he showed money or the U.S. dollar. So I'll go ahead and roll one of the clips for you. So you can see it starts off with the White House, Andrew Jackson, Federal Reserve logo, and the Treasury logo. So again, in this part, clip one, Andrew Jackson, the White House, Andrew Jackson, Federal Reserve System logo, and then the Treasury logo. The second part, again, Jackson, a printed $20 and a gold $20 and a gold Federal Reserve symbol. Okay, so that it's like, okay, what's going on now? He's moving from a printed paper 20 to a gold printed 20. So what is he doing? Is he trying to share some type of a message, or is he trying to say something to us about what he plans to do in 2020? Remember, he got Judy Shelton in there, and she likes gold. And the third part of it, Secretary of the Treasury, U.S. flag, again, gold on that 2020. So I mean, Trump, he's, whether you like the guy or not, he knows how to troll each and every one of us. So when I saw his ad, and then the original ad, these things just flip by. They're not even half a second long. It just goes really quick, like a subliminal message. So the part I found interesting was that he kept including gold in the 2020, as you can see there. So pretty cool. I came across that ad. I'm like, hey, what is this? Why is he putting this $20 bill in there? Showing it printed, a printed $20, and then showing the gold $20. I know he has Judy Shelton in there. Federal Reserve logo switched from printed to gold, and is he trying to tell us something? Especially with Andrew Jackson, because Andrew Jackson, hang on, let me put this over here for you guys. Andrew Jackson, he did not like central banks at all, and he one of his quotes, the bold effort to present central bank, or the bold effort the present central bank had made to control the government are but premonitions of the fate that await the American people should they be deluded into a perpetuation of this institution or the establishment of another like it. And that's coming from Andrew Jackson. So again, hey, what is Trump doing? Why is he showing Andrew Jackson? Why is he showing a printed 20, and then representing maybe a fiat 20, and then he's showing a gold 20, and then after that the word reserve? What what's he doing again? Anyway, good to see your comments here. Um, let's see, Susan Klein, new currency, the gold backed dollar. Maybe, uh, maybe. I'm a fan for sound money. I'd like to see a gold backed dollar. That's for sure. Will they give it to us? Not without a fight. I don't think they're just gonna lay over, or lay down one day, roll over, and say, okay, we'll do it. We'll go ahead and do it. Things have got to change for this. Jack Yeoman, if the Fed bails out banks, then bail out hedge funds, or who is next in line? Jack, we're going to get into that, because you may not know this, or a lot of us don't know this, but what is coming out is the Fed is going to change a few things, where you might even want to call it bailing out hedge funds, and we're going to touch on that. Definitely, we're going to touch on that. But for now, it does seem that the Fed is definitely stuck in a QE hell, and this is coming from Market Watch. Federal Reserve is stuck in a QE hell. The bank's short-term buying of securities could morph into long-term easing. And here we go with the article. Imagine doing the same thing over and over again with little progress, no relief. Sounds like most people's vision of hell, or the Federal Reserve's current predicament. Since September, the central bank, through the Federal Reserve Bank of New York, has been purchasing securities hand over fist. Might want to throw in your feet as well to alleviate short term pressures in the overnight money markets. It has used repurchase, or repo, and reverse repurchase, or reverse repo agreements to provide liquidity and keep overnight borrowing rates from spiking. But these complex money market operations already have caused the Fed to buy a net 400 billion worth of securities after Chairman Jerome Powell shrank the Fed balance sheet by 700 billion. That normalization, which also included raising the federal funds rate through late 2018, is now effectively dead, and the Fed's balance sheet is growing again. Powell and the Fed have repeatedly denied this is a new phase of QE, three rounds of which added 3.6 trillion to the Fed's balance sheet in the years after the great financial crisis. Indeed, in the earlier rounds of QE, The central bank bought treasuries and mortgage backed securities of various maturities. The current buying has been focused on treasuries with maturities of 12 months or less. So, again, I think this author, I mean, I'm saying he's wrong, but take a look at the mortgage backed as well. Again, people, they tend to only look at treasuries, not the mortgage backed, and it's the mortgage backed that's definitely growing. On the way, QE4, but that may not continue, says Daniel DiMartino Booth, chief strategist at Quill Intelligence, a Dallas based boutique research firm. Booth, who worked on both Wall Street and in the Fed, Federal Reserve Bank of Dallas, has been a critic of Fed policies since the central bank pushed Fed fund rates, the Fed funds down to near zero, and launched its three rounds of QE after the financial crisis. She was also one of the few people to connect the dots between the housing bust and Wall Street before it hit. And we've had the pleasure to interview Danielle twice, and she always has some pretty good info. Um, Still more on the academic side. I guess some of us look like tinfoil hat wearers, but she's definitely, on the academic side. She understands it, and I think she has a good balance of academic and we the people. So she has kind of a good balance there. Nonetheless, Booth thinks we're on the cusp of QE4, probably already there. We surpassed the 400 billion mark. She said in a phone interview, they call it not QE because its maturities of 12 months or less, and therefore presupposed to roll over in 12 months. So I guess because there's a time factor on these, that's why they can get away with not calling it QE. Um, anyway, hang on, excuse me. Oh, excuse me, there, I had to cough. Um, Booth acknowledges there's a qualitative difference between current options and the Fed's QE policy of buying longer dated securities, particularly mortgage backed bonds. Okay, here we go, which also helped boost the housing market. And the current efforts to stabilize the overnight money markets may run through at least April after tax season. So, we're heading into some pretty serious times again. We're always in serious times, but with what the Fed is doing, um, I, I don't think there's really any true price discovery in anything. I mean, you get that cheap money, you do whatever you want with it. I mean, there's no consequence, So I think there has to be a consequence if you're ever truly going to find market discovery. You have to know what works, what doesn't work, what people like, what people don't like. If you're just going to be, been giving you're giving cheap money, you don't have that fear so much, or that consequence. So Fed, I don't think they're working in our favor right now, which is going to take us to what the bulk of the rest of this program is going to be about. A liquidity trap, also called zero lower bound. It's a situation in which nominal interest rates are already close to zero, and any further increase in money supply does not have any expansionary effect. Um, Liquidity trap, I think this is a word we're going to be hearing more and more and more, and even from the Bank of England. He has his concern where the Bank of England chief warns central banks aren't prepared to combat the next recession. Mark Carney is his name, said central banks are low on ammunition to combat the next recession. The global economy is headed for a liquidity trap. We're going to hear more of this word, guarantee you. And central banks are running low on ways to fight a future recession, warned Mark Carney, governor of the Bank of England, in a recent interview with the Financial Times. In his wide ranging and exclusive interview with the Financial Times, the Bank of England governor stated his concern that central banks around the world are ill prepared to prevent the next major economic downturn. The greatest concern for the British economy and those of other advanced countries is how central banks would be able to combat a future economic recession, and monetary policy alone may not be enough to do so. So, liquidity trap. Um, some of us might be familiar with that word. Some of us might not be. It may be something new that maybe it's time to understand. So this is a little bit of an older clip where this gentleman explains what a liquidity trap is, and I think you're going to see that he's pretty darn close to where we're at today, even though this clip was made years ago. So, liquidity trap, what is it?
Let's talk about what a liquidity trap really is. This happens when you're trying to stimulate a economy in recession. So, for example, let's imagine that you have this entity over here. This is your central bank. And what they're trying to do is stimulate the economy. And one of the ways that the central bank does this is they will inject cashola into the economy. Now, what they try to do when they're injecting cash is to lower interest rates, because theoretically, if you increase the supply of cash, you lower the cost of capital. So it makes businesses more likely to invest. If they're more likely to invest, then they're more likely to expand. And if they're more likely to expand, then they're doing a couple of things that the Fed's very interested in. One of which is, one of the prime objectives of the Fed is to maintain job stability or job growth. So if businesses are expanding because they have access to cheap capital, which is important for entrepreneurs of all kinds to have access to capital, then this is likely to lead to job growth. However, here's what happens in a liquidity trap. So how does the Fed get that money out into the economy? Well, they get it out through the reserve system, and so they send it basically to banks. And what they're doing is they send the money to the banks, and what they're borrowing or what they're buying with that money is debt. So they buy back U.S. debt. It's a little known fact, I've mentioned this before, that actually the government itself, the Fed and the government as a whole in the U.S. owns half the debt basically out there available. So they're actually we're our own biggest borrower. Well, so we're buying that debt, or the central bank is, and they're sending money that direction. Now here's what happens. This is the trap part. So theoretically, what you're hoping is that entrepreneurs are going to come out and they're going to try to borrow money from these banks. But instead, these banks and this should make a lot of sense to traders. Have you ever gone through a losing streak? Well, we all have, right? And do you tend to be a little bit of gun shy as you suffer a couple of extraordinary losses, particularly active traders? So you reserve a little bit more capital, you hold it back to cover potentially other bad investments you have out there, and heck, you haven't been doing so well with your lending lately. Do you really want to just suddenly start shoving that money back out there? Not to mention the fact that maybe rates are going to go up in the future, and so safer investments might be available in the future. So you hold on to this money and you don't send it out. So this last part of the puzzle doesn't actually happen. None of that money gets out into the economy. Now this is very much an overgeneralization, but essentially this is what's happening in the U.S.
Okay. Okay. Oops, excuse me. Okay. And that's exactly what's happening. You know, these lower rates, the money coming in, we're seeing all this money, but we're not really seeing it moving. No matter what the Fed does, lowering interest rates, we're not getting the inflation. And what's happening is the banks they're holding a lot of this money, just as this gentleman showed, a lot of times in excess reserves. And he does have a little bit more to say to help us understand liquidity trap. So I'll go ahead and continue with what he has to say.
So what do you do to avoid this? Well, one of the things that you can do is you can just circumvent this whole process, and the government can inject money in the form of essentially gifts to businesses and consumers. So what's the problem with all this stuff? Why is a liquidity trap bad? Let's talk about this before we start getting into the risks and opportunities. Well, number one is ultimately a liquidity trap. As you buy the debt, as the central bank is buying the debt, it increases demand for that debt, right? Well, what happens when you increase demand for an asset? Its price rises, which means that yields fall, which means that essentially what you're trying to do is you're bringing interest rates down to 0%. Now, we're very close to that right now in the U.S. So here's one of the big problems, is that it's suddenly removed tools needed by the Federal Reserve or the central bank to manage economic growth, to manage monetary policy. So if you've already gone down to zero, there's nowhere else to go, and you're operating with one arm behind your back. This is not what the European Central Bank wants to have to deal with. The Fed's dealing with it right now. It's bad enough. So what about number two? The other issue is that there's not necessarily a really strong connection between making capital really cheap and increasing demand for that capital. So you see everybody writing these days about how the banks won't release this capital. Well, it's not necessarily true. One of the problems is there's not enough demand for the capital. There's not enough demand to pay the rates required for that capital. So just lowering rates doesn't necessarily increase that demand. And in fact, the problem is that ultimately, if it doesn't increase demand, you can get into a deflationary spiral, which is something we've been talking about. So there's a very loose connection in that it doesn't necessarily stimulate demand. And it kind of feeds the beast. If you were in this situation because of an asset bubble, just making capital less expensive so that it can be invested in new assets, it's kind of like treating somebody for alcohol poisoning by giving them more alcohol. So hard liquor is not really the solution when you're already suffering from alcohol poisoning. And this is really the problem with that. Finally, number three is it creates its own risk of bubbles. So we're in this because of bubbles, right? Asset bubbles, housing specifically is one that we talk about all the time. But what is the bubble that this is causing right here? Well, it has a lot to do with kind of this 1-2 punch. We've got low capital costs. So we have this 0% interest rate. We've got a central bank with its arms tied. And then we have this plan by the government to just circumvent this whole process and start injecting capital into the economy as essentially gifts.
Okay, so there's a plan to inject it as essentially gifts. Okay, so this money is tied up. They're desperately trying to find a way to get it out, and the Fed has a new tool. So here we go again. The Fed is going to create a new tool to try and get that money out of, and we're going to call it the liquidity trap. Hedge funds could make one potential Fed repo market fix hard to stomach. Federal Reserve officials are considering a new tool to ease stresses in the repo market, and I think you guys are gonna like this once we get into the meat of it. Federal Reserve officials are considering a new tool to ease stresses in the market for Treasury repurchase agreements or repos. Through the repo market, banks and hedge funds borrow cash overnight while pledging safe securities such as government bonds as collateral. And we all know back in September, an unexpected shortage of available cash to lend sparked a surge in the cost of repo market borrowing, prompting the Fed to intervene for the first time since the financial crisis. One potential solution is to lend cash. Get this now. One potential solution is to lend cash directly to smaller banks, securities dealers, and hedge funds through the repo markets clearinghouse, the Fixed Income Clearing Corps, or FICC. So the Fed's new tool, just take a little detour and give it straight to some of these other entities. Hedge funds currently borrow through a process called sponsored repo, in which they ask a large bank to act as a middleman, preparing or pairing their government bonds with money market funds willing to lend cash. The bank then guarantees that the parties will fulfill their obligations, repaying the cash or returning the securities. Firms trading through the FICC contribute to a fund that would cover a borrower's default. Critics of the new plan say if the Fed lends cash directly through the clearinghouse, it could end up contributing to a hedge fund bailout. So, what are we seeing here, guys? What are we seeing? What's going on now? The Fed's aim, according to analysts, is to step back from temporary efforts to quell repo market volatility and increase financial reserves. After September's volatility, officials succeeded in suppressing year-end swings with temporary measures such as offering short term repo loans and buying treasury bills. Yet the new approach could also create political problems for policymakers. The problem centers on the central bank lending directly to hedge funds, the unregulated investment vehicles that tend to serve wealthy or institutional investors. Are we happy with that? Or are we happy with that? Because this is it's a new tool again that is gonna, I guess the Fed is looking to lend money straight to hedge funds.
Well, isn't that special?
Yeah, very special. I think you guys remember that from Saturday Night Live. If you're as old as I am, you'll if you're as old as I am, then you know who that was. But it's a new tool. Um, they are going to try and find another way to do whatever it is they feel they need to do, and it's you and me, average Joe. You know, we're not even getting a whiff of any of this or smelling any of it, and we always gotta dig deep and find out what the Fed is doing and if it's actually helping or hurting us. So curious to see what you guys have to say. Let's see. Banks can borrow. This is IBJI. Banks can borrow at 0%. Basically, yeah, not much. Just little over than that though. Regular people pay 17% on credit cards. Real fair. Yeah, that was one of the things that the banks aren't being penalized, and I think if they were penalized, you'd see them probably be a bit more. They tighten up the belts more, and but it's just cheap money. They have that cheap money, and they'll go ahead and basically do whatever they want to do with it. Debt can never be repaid. It's mathematically impossible. Tiger Roll, you're correct. I mean, there's been a bunch of guys that have proven that already. Gifts, covert way of saying bailouts. Absolutely. Um, there are other so-called gifts where things like some people say infrastructure is another way to get out of that liquidity trap where the government will just go ahead and create jobs and infrastructure type jobs, get people to work, get money in their hands, and get them to hopefully kickstart that velocity of money and hopefully push up inflation a bit. But some people also say that these really don't help, and we'll get into that a bit. So the question is really, has the Fed really trapped itself at this point with all of this meddling that they've done? And a lot of people are thinking yes, they really have. So again, this is Lance Roberts. Here we go. Lance Roberts. Has the Fed trapped itself? So that is the current mantra of the markets as we begin 2020, and it certainly seems to be the right call over the last few months. Federal Reserve has continued its QE, not QE operations only because of that maturity date allows the Fed to not call it QE, nonetheless, which has dramatically expanded its balance sheet. Many argue, rightly, the current monetary interventions by the Fed are technically not QE because they are purchasing treasury bills than long term treasury notes. However, Mr. Market doesn't see it that way. As the old saying goes, if it looks, walks, and quacks like a duck, it's a duck. So, as we discussed, there is something broken in the financial system when it requires massive injections of capital to maintain sufficient liquidity. This was this was a point noted by Curvature Securities Scott Skirm in his daily repo market commentary on Zero Hedge. He goes on to say, indeed, something appears amiss because the total overnight and term Fed RP operations on Friday were last week greater than on year end. On year end, the Fed had pumped a total of 255 billion into the market versus 258 billion on Friday. When these excessive repurchase operations initially began in late September, we were told they were to meet corporate tax payments. Remember that now? Remember corporate tax payments? That was I mean, I'll just say that was flat out BS, and all of us know that. That's why we don't appreciate Jerome Powell coming out with that lavender tie and just basically lying to us. I think we all knew it. Uh, Article goes on to say the issue with that excuse is that corporate tax payments come due every quarter and are easy to forecast weeks in advance. Exactly. Why was last October's payment period so different? But following October 15th, the repo operation should have been no longer needed. However, the funding not only continued but grew. Excuse me. As the end of the year approached, we were told liquidity was needed to meet the turn as 2019 ended and 2020 began. Once again, this excuse falls short, as without exception, every year ends on December 31st. So, after a decade of no repo operations, as shown below, what's really going on? That's a pretty interesting spike there. So you can see for like those 10 years or so, we're okay, and all of a sudden, look at that. That is that is a tower. That's a tower going up and still being built. What is clear is that the Fed may be trapped in their own process. A point made by Mark Obama. It seems implausible to me that the Fed will be able to stop their repo operations by the end of January. The Fed's new liquidity trap. We previously discussed the liquidity trap the Fed has gotten themselves into, along with Japan, which will plague economic growth in the future. The signature characteristics of a liquidity trap are short-term interest rates, check, that are near zero, check, and fluctuations in the monetary base that fail to translate into fluctuations in general price levels, check. So we have all of these things already. We have each and every one of them, and this is the gentleman who made this article, Lance Roberts. This is what he also had to say.
There is a thing called a liquidity trap. And the definition of a liquidity trap is a situation, and this is actually the actual definition. A liquidity trap is the situation described in Keynesian economics in which injections of cash into the private banking system, so listen to these words, injections of cash into the private banking system, a la QE, by a central bank, the Federal Reserve, fail to lower interest rates and hence fail to stimulate economic growth. A liquidity trap is caused when people hoard cash because they expect an adverse event such as deflation, insufficient aggregate demand, or war. Signature, and here's the primary sentence here, signature characteristics of a liquidity trap are short-term interest rates that are near zero. Federal Reserve is now at 1.5. It's pretty close to zero. And fluctuations in the monetary base fail to translate into general price levels. In other words, you can't create inflation. So you would think that with interest rates near zero, people would be borrowing like crazy, right? They're just going to borrow like crazy and go spend money, and it's great. And because of this demand push in the system, right? I'm borrowing money, I'm buying stuff, that's going to push the prices of goods and services up. But yet that's not occurring. According to the Fed, that's not occurring. So here's really the questions about where we are. Are the central banks injecting liquidity into the financial system? That's a global answer to that is yes. Every bank in the world is flooding the system with liquidity. Has the increase in liquidity into the private banking system lowered interest rates? Absolutely yes, to a point. What we're seeing is that interest rates on debt, credit cards, corporate debt, etc., are actually stable and rising. It's only the interest rates that the Feds control, the central banks control, that are now being pushed negative. So the problem here is that what the Fed has just admitted to is that they cannot create inflation. And they are going to continue to put liquidity into the system. They are going to continue to keep interest rates near zero because they've given up now on creating inflation in the economy. They've admitted defeat without actually coming out directly and saying it. But this
Okay, liquidity trap. What do you think? Or what do you think, guys? Are we in this liquidity trap? And I'm gonna go through some charts directly from the Fed itself in a bit to expand on this a bit more. But what do you guys think so far? Are we in this so-called liquidity trap? And liquidity trap is one of the things that led to Japan's stagflation. So we're a lot of times we hear the U.S. is Japanification is coming to the U.S. and this is one of the reasons why people will say these things. So what do you guys think? Liquidity trap? Are we there? Are we in it? Uh, all the symptoms of it are there. All the signs of that liquidity trap sickness are there. But really, truly, are we there? And for me, I'm going to say yes. I just think that coming this year, we're going to hear more and more of that word. So, I'm just really curious to see what you guys think about that. Let's see. Ride the curve. Think about it. Oh man, I sure did. He's gonna line his and his buddies' pockets at all our expense. End of story. Last one out of the room. Turn off the light. Um, that's a tough one. I mean, the money's got to get out somehow. But what do you do? Do you give people vouchers who have mortgages? You give them a voucher, $1,000 a month voucher. What do you do? Do you pay down student loans? People who have car notes, what do you do? Do you start giving car note vouchers for this and that, this and that? I mean, what do you start do? Because then that starts. Would it not be leaning more towards socialism at that point? So really, what do you do with this money that seems to be tied up now? I mean, I would love for it to go into the hands of the people, of course, but would we be leaning towards socialism at that point? But anyway, that's a different topic. Really, are we in this so-called liquidity trap? Um, as I mentioned earlier, some people they think they seem to think that having infrastructure projects will help the economy. And this is an article from the Mises Institute where it's titled "The Myth of Infrastructure Spending." Mises Institute, I like them. I'll agree. Okay, go ahead and take my cookies. Anyway, Trump's $1 trillion infrastructure spending plan continues to be one of his less controversial proposed policies in Washington. And even among many in the general public, there is a consensus that government spending on more roads and bridges is always a slam dunk. This is coming from CNN. Infrastructure spending is a proven winner for the economy. It creates jobs, fuels growth, and allows Americans to get from point A to B faster, making them more productive. So far, it sounds all good, right? The statement is not a quotation from any supporter of the plan. The author of the article is simply stating what he believes to be an indisputable fact. The fact that statements like this are made in such a blasé way should not surprise us. This attitude goes back to at least the early 19th century when it was assumed that government infrastructure programs were all necessarily proven winners for the metaphorical construct known as the economy. 200 years of boondoggles. Perhaps the most famous example of this is the Transcontinental Railroad, which is still held up as the great proof that massive infrastructure projects are indisputably net gains for the nation. In reality, the Transcontinentals were never proven winners and were actually huge engines of debt and corruption in 19th century America. They siphoned off vast amounts of wealth from other uses where money would have been better spent. Even worse, the railroads, like all infrastructure, required constant upkeep. Thus, the creation of new infrastructure was really a creation of future government commitments for more government spending. Transcontinental Railroads. This is historian Richard White noted the Transcontinental Railroads were less an asset that one generation passed on to the next than a debt that the past imposed on present and future. I mean, this quite literally. They, the seeming durability of the iron, steel, and stone that made up railroad was, if not an illusion, then largely relative. The wind and rain and ice, snow, the flood and the landslides, the rust, the rot, and the fire that ate away at railroads meant that they had to be constantly repaired and rebuilt or they ceased to function. When 19th century editorialists proclaimed that the fraud, deception, and loss of capital that the railroads entailed ultimately did not matter because Americans now had the railroad, they did not know what they were talking about. Without constant new investment and labor, the railroads would have been useless. All of the watered stock, the money siphoned off into private pockets, waste, the fraud that characterized the building of railroads created a corporate debt that had to be paid through higher rates and scrimping on service. A shipper in 1885 was still paying for the frauds of the 1860s. And I want to move on into some charts from the Federal Reserve, and I hope I do this well because these things are pretty darn interesting. This chart right here, what we're looking at, is the effective federal funds rate. This is when Jerome Powell comes on and says, the Fed is going to reduce interest rates, the Fed is going to raise interest rates. Interest rates are not moving, they're going to be the same. Each of these gray bars going vertical, here, 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 here. These are recessions. All of these gray bars represent times of recession. So the last one we had, of course, 2007, 2008. Okay. And what you see here is at that time, the interest rate was about 5% or so. At the end of the recession, it was right about zero. And this is why people will say it takes about, 4 to 5% of rate cuts to get through a recession. We look at here, 6.4, roughly 6.4. We look at here, 1.8. So again, about 5%. We look at here, 11.9. Interest rate came down to 5.2. So again, in these times of recession, the Fed usually needs to cut rate somewhere around 4, 5% or so to get through that recession or to help the economy get through it. We're here today. We're at 1.5. And this is why a lot of people are worried because we're at this 1.5 level. And if a recession were to come, where do we go from 1.5? We're going to go to negative 3, negative 3.5. So effective federal funds rate. This is basically when Jerome Powell comes out and says this is what we're gonna raise the rates, lower rates. Rates are gonna stay the same, whatever it is. Now, the other one I want to take a look at is the velocity of money. Velocity of money is it's how quickly are we spending our money over time. Okay. Now this chart doesn't really look like much until you go ahead and if you ever been here, this Fed website is pretty interesting. What you can do is you can edit the graph. Okay. You click on that, you add a line, and you want it to be that effective Fed funds rate. Okay, so we're going to go ahead and take a look at that one. And we'll add it. So what's going to happen is it's going to overlay that first chart onto this next chart. And then we'll see the two combined. Okay, so let me get out of this. Okay, so again, it really doesn't look like much except this blue line here, velocity of money. So you can see even through those gray vertical bars that are going up and down, those gray bars, velocity of money typically always kept going up, kept going up, kept going up, kept going up until 2008, where now the velocity of money drops. And no matter how low the Fed takes the interest rate, the velocity of money is just not kicking in. Okay. And that again is one of the definitions of liquidity trap. So the lower interest rates, but the money is trapped. It's just not getting out there. Another definition of in fact, let me just stretch this out a bit for you so or condense it a bit so you can see that a bit better. Sorry guys, just bear with me a bit. So this essentially is what we have. The gray vertical bar represents the recession, the Great Recession, 27, 28. The red line represents the Fed funds rate or interest rates. We can see that it went basically down to zero for quite a long time, came back up, had to go back down. The blue line on top, the velocity of money, we can see that no matter what the Fed did, the velocity of money never did pick up. Again, that's one of the definitions of liquidity trap. Another definition is the money supply. If we take a look at the M1 money stock supply, we're just going to see it shooting straight up, basically. And again, you look at the last gray line, which is 2007, 2008 crisis. And after that, we see a whole lot of money printing going on, a whole lot of it. And again, another definition of liquidity trap. And then if we go ahead and look at the excess reserves of depository institutions, what this is banks are required to keep certain reserve levels with the Fed, and sometimes they have excess. So if you look at this whole thing never started until 2008. Again, the financial crisis. The last gray bar represents the recession, 2007, 2008. And of course, we had Dodd Frank, which basically says that banks need to have so much in reserves nowadays, which is why it never really started to 2008. So we see this one here. And then we're going to take a look at the Fed balance sheet. Okay. So again, we saw that earlier, but let's take a look at the Fed balance sheet. And here we are. You know, this is September, this dip right here, and it's been going up ever since. Now, the thing is, if we go ahead and lay over the excess reserves, sorry about that. December. Okay, so here we go. So we'll lay over that chart that we just saw earlier, and then you're gonna see something pretty darn cool. Okay, so let me bring this in a bit more, really, to just the parts that we need. Okay, so again, this gray bar at the beginning, that is the recession, 2007, 2008. Now look at these guys. Would you say that's a correlation? I definitely would. There is a correlation between the Fed balance sheet and the excess reserves of depository institutions. Again, there's cheap money out there. And what they're doing with the cheap money is, apparently it looks like they tend to keep it in the Fed. And why are they keeping it at the Fed? Because they will get interest on it. Sorry about that. So if we and what I mean is this. Sorry about that. I'm just trying to flip through a few buttons here. But what happens is this excess reserves, they get interest on it. Fed funds and interest on reserves. So Federal Reserve banks have been paying interest on reserves to DIs, the deposit institutions, since October 2008 because of Dodd Frank. The Board of Governors is responsible for setting the rates for IOR, interest on reserves. IOER, interest on excess reserves, which was the chart we just looked at, works to influence market rates by providing DIs, or deposit institutions, little incentive to lead Fed funds at rates below the IOER rate, the interest on excess reserves rate. While the interest on excessive reserves rate has been effective at influencing the FFER, it has not served as a hard minimum rate at which all institutions are willing to lend funds. This is because some institutions are eligible to lend funds in the federal funds rate, but are not eligible to earn IOER, such as government-sponsored enterprises, U.S. branch agencies. Okay, basically, I'll just say this. What it means is liquidity is basically being trapped. I mean, imagine if you're a bank and you have excess reserves, but let's say, what if you see too much risk out there, and you find it safer to simply get the interest from the Fed, the IOER, the interest from the Fed with your excess reserves, or maybe there's no takers, too much liquidity in the markets, too much risk. If the Fed's plan was working, you would not see the excess reserves following or mimicking the Fed balance sheet. What you would have seen was that line would have started to disengage and go down, meaning the banks would have been putting that money back out in the economy. Um, you would see the excess reserves lessening because it's going out into the market instead of going into Fed, just sitting there as a reserve. Again, what we're seeing is liquidity is trapped. That liquidity is definitely trapped right now. And I just want to get to some of your comments. I know that was pretty long here. Um, Let me see. Bill Holder talks about a human reset currency which will fail after 1 or 2 years. California scary place. Let's see. So many people try hard to be successful, but for some people, no matter how hard they try, they'll never make it. Sad but true. That sad but true. Um, Low interest and loaning is a hook bait. Yeah, of course. Okay. So I hope I'm not losing you guys with this, because what I'm trying to show is it does look like we are in that liquidity trap. Um, so if I take a look at one more time the Fed funds rate. Okay, so here we are again, Fed funds rate, and what I want to do is overlay the IOER, or the interest on excess reserves. Okay, so here we are. I'll add it. Then we're going to get an overlay of the Fed funds rate and interest on excess reserves. So let me clear this out. Let me pinch it down to the parts that we need, which is about the 2010 area. So I'll just come down to here a little bit more. Okay, so basically, if you look at this, we have two lines. The blue line is the Fed funds rate, which is when Jerome Powell comes on and says, okay, we're cutting rates, this, that, this, that, this, that. The red line is the interest on the Fed, or the interest on excess reserves, which means, as you can see here, the red line is pretty much always above the blue line. So whatever the Fed says the interest rate is, the interest rate on excess reserves, the excess reserves that banks have through getting cheap cash, seems to always be higher than the Fed funds rate. So, in a sense, I mean, wouldn't that kind of mean that the bank will just decide to take that cheap money, leave it in the Fed, and collect interest on it? It's just a money making a money making scheme here that's going on. Banks will park it at the Fed. They'll park it at the Fed, collect the interest on it, and you don't see that money coming out again. That so-called liquidity trap, absolutely Fed induced. It's absolutely Fed induced. And the question I have, I mean, it looks like banks or deposit institutions will simply keep their excess reserves with the Fed. If I'm seeing this chart right, which I'm pretty sure I am, the Fed is paying a higher interest rate than the effective funds rate for banks to simply let their money sit at the Fed and gain interest. Question is not if we're in a liquidity trap. I think we are. The question is, are we now in a zombie economy with zombie banks and zombie businesses? And I know you guys have heard that term before. And looking at these charts, this is probably one of the reasons why people will say that. So, I mean, I know this was a bit deeper than we normally go. I hope I explained it a bit well. It was really just to point out that I believe we are in a liquidity trap, and I think we're going to start hearing those words more and more. I think we're going to see a lot of gifts. Some of you guys called it helicopter money. I think we're going to see it as infrastructure spending. The Fed has already said a new tool is they'll just give money straight to banks and hedge funds, and smaller banks and hedge funds, gifts. So I mean, these things, they're not going to make the news, unless you really dig and look for it. Then you'll come across it. But I think these things are things that we all need to understand that's happening in the background. Um, I don't think these things are good for the economy, and that it really is a zombie economy. I mean, it's, for all intents and purposes, it probably could be dead, and the Fed is just again, that whole weekend at Bernie's thing, just keeping everything alive. So again, what say you? We're tangled. Rolf's, let me see. RR, we're tangled. What a tangled web we weave when we try to deceive. Yeah, so stay away from lavender ties. None of us should be wearing lavender ties, okay? There's something with lavender ties that just will not give people any sort of truth nowadays. Um, let's see. Don't forget bail-ins, LLD, absolutely. The bail-ins, as mentioned, it's the Fed is looking at a sort of a hedge fund bailout anyway. But the bail-ins, that's going to be you and I. That's when they'll come after us. What we have to help the situations out. And again, don't think that bail-ins are some type of a conspiracy thing because back in 2014, G20 signed it, where a bail-in type of a arrangement where banks can go in and take your deposit if they need to. This isn't a conspiracy thing. It's real. It was a signed agreement by the G20. Um, let's see. Shane Clements, I wouldn't underestimate the Americans. The noisy ones are just hot air. Okay. I'm hot air, I guess. I don't know. Nameless. Thailand is safer. Depends. I think every country is going to go through their own bout of change, reform, if you want to call it that. I think every country is going to have to kind of go through it. Again, with the dollar being the reserve currency, if the dollar gets in trouble, other currencies are going to get in trouble. And if, other countries that know this want to get away from the dollar, then they're going to have to play ball with other countries who are looking to take the lead, which means some of their policies or whatever may have to change as well. So I think no matter what, we're going to change, and unless your country is uniquely positioned where it straddles the fence, and I'll say Singapore is one of those countries that can uniquely straddle the fence. Um, for the most part, every country is going to have to make a decision, left or right or whatever it is, unless you're that type of a country that has the ability to stay on that fence. And again, Singapore is one of those. They've proven it time and time again, and I think no matter what happens, Singapore will still be a country that can straddle that fence. It's a good thing. Let's see, Thomas Toots. My long term plan is to live off. I'll end it there, Thomas. Let's see. Nick B, to see what happens when a country loses the reserve currency, just look at the UK. UK, I think that was a bit of a different time because the UK, I mean, it didn't, they went through hardships for sure, but not a full on collapse. I don't think they went through a full on collapse. So, I mean, this is something none of us have seen. So I think it may be a little bit different. But yes, UK did go through its bout of hardships as well. But I think it's going to be magnitudes larger this time. Definitely will be. Um, Another article that came across. Just want to share real quick with you guys before we head out. Liquidity Trap and gold. So let me go down a bit. Um, it's looking increasingly likely that the markets are pointing towards a liquidity trap, ask the Japanese. They know all about it after their years of experience over the last decade. Let's see what a liquidity trap actually means when traditional monetary policy is unable to stimulate the economy either through lowering of interest rates, which they have, or increasing money supply, which I showed you. Liquidity traps typically occur when expectation of adverse events make persons with liquidity unwilling to invest, which we're seeing sort of, and take up even calculated investment risk, which we are seeing more risk. It's a situation where the central banks find it difficult with all their armor of fiscal weaponry to improve the environment through monetary policy, which is where we are today. Even though there is money supply around, again, which there is, which to date does not cost that much, which is correct. This alone does not mean that credit demand will pick up automatically. There needs to be a willingness to commit this liquidity rather than save it for another day. Look at Japan once again, where money supply has increased threefold, inflation has gone down while GDP has barely moved. In our own scenario, an individual's appetite for risk has diminished completely. Individuals seek only a very safe haven for their money. Also, as they are averse to spend more than is necessary, they would be saving much more than usual. The banks are also being very much more cautious, and thus the bank's liquidity is in the current scenario being built up by this extra savings, but they too are not placing this liquidity back with the markets as their lending policy becomes more and more cautious. Hence, the liquidity, less spending, less investment equals the liquidity trapped with no place to go. All pressure now lies with the central banks because of their meddling. And if they are not able to get it right and deliver, then more QE might have to be made. But is this the answer? Also, if they get it wrong, or if one country manages to pop up yet another bunny out of the hat full of bad news, then what? And how has gold been behaving amid the turbulence? Gold prices have been as wild as the market. And at one stage recently, gold was up by nearly 100 USD per day. I'll stop here. Why? Because although this article sounds like it's coming from today, it was back in September of 2011. Deja vu all over again. We are doing the same things all over again. Gold, together with the Swiss franc at that time, anyway, Swiss franc, are considered as a safe haven of choice during these debt ridden, uncertain times, and that is the way it is expected to stay amidst these times of such economic turbulence. So there you go. That article was all the way back from 2011. Sounds like today. What they do in 2011 went into gold, went into silver. What did we see? Prices of those two metals shoot up. Good chance the price of those two metals may shoot up again. I would say very good chance. Showed you earlier in the program where hedge fund is a hedge fund manager is expecting $2,000 gold this year, which would surpass the 1900 level back in 2011. So we're seeing the same things all over again, but magnitudes worse. And again, this is why you should be getting, again, it's not financial advice. This is just, let's just say this is what I do. It's not financial advice, professional or otherwise. Get yourself some gold, get yourself some silver. Price is one thing, yes. Insurance is a whole nother ball game because we are definitely going to need that insurance when these things happen. We are definitely going to need to be able to have a store of wealth when these fiat, um, basically when they die. No fiat lives forever. You need to be able to have a vehicle that can transfer or store your wealth and transfer it over into whatever that new monetary system is going to be. And that vehicle is typically gold, typically silver. So make sure you guys are getting yourself some of these things, right? Let's see. Rolf Steiner, the elites will take to sea with their models and yachts. We'll be fighting in the streets for scraps. Uh, possibly, possibly. Can't rule it out. Definitely cannot rule it out. Gabby, I have 5 houses. Um, we may be knocking on some of those doors there, Gabby. Bobby Jones, the government won't let the system go bust. They'll let another country go bust first so they can point fingers. Bobby, could be. The other half of it is another country just may come out with something, and other countries may opt to choose what that other country has come out with. I mean, countries have known for a very long time, U.S. dollar cannot continue the way it has, and they've had time to build up whatever new monetary system it might be that they see fit or that they want to control, being that they want to get out of the U.S. dollar. So, yeah, two options. I mean, point the finger or create your own and move on from where the U.S. is at, and that one is for me a bit spooky because you don't know who that country is going to be. A lot of people suspect it's China. A lot of people suspect China's going to come out with their gold backed currency or crypto this year sometime. Um, that would definitely put the U.S. in an election year, nonetheless, in absolute peril. I mean, can you imagine that? You come out with a new currency, gold back. The world loves it. They leave the U.S. dollar, and here it is, an election year in the U.S. I mean, talk about a house of cards all coming down at one time. That would be amazing, and if that happened, that would be truly amazing. BL Germany promotion new gold registration law. Google it. Yeah, BL. Is it correct? I think if you're buying more than 2,000 in cash, then they need to kind of check on you a bit. Okay, let's see. Nick B, a commodity backed crypto could be very powerful. Nick B, I agree. I do agree with that. We need something real. Absolutely need something real. Some type of commodity backed crypto. I'm looking at gold. I know there's also silver out there, but gold mainly because that's what central banks are holding in reserves. So it would, I say, it would be easier. I don't know if that's the right word. Easier to have that gold in reserves backing some type of a crypto, new monetary system involving gold backed crypto. So that's again we'll have to see how that unfolds. RR gold and silver shortages in Netherlands. Oh, okay. I haven't seen that one. I have to look that one up as well. Thanks, RR. Let's see. Stan Skeleton. Your name always gets me. Stan Skeleton, Randy Fresh Hour, sure. But definitely the UN will stand up with a currency basket and at that digital coins include a lot of people I'm seeing more and more people saying this where the SDR, that basket of currencies, fiat is going to end up because they do have gold. I do believe gold is a part of that basket, and if they have that gold, then and I know that IMF is looking at some type of a crypto, then it would make sense. I mean, it's the pieces are all there. How they will assemble it, don't know, but the pieces, it's all there. Thomas Stoops, Gen 3 is civilian also. Gen 3, I gotta see what's that about. Uh, Weme, Faith, prepare your food. It's gold for what's coming. Okay. Kawi Kanekoa, aloha. How you doing, Kawi? Tough news going on back in Hawaii right now, huh? SM Smooth, Silverback Crypto. Wait, Kawi. How you doing, Kawi? Silverback Crypto, SM Smooth could be. I know David Morgan. He's been voicing out on Load, which is a silverbacked type of crypto. Um, again, these would be sort of what we might want to loosely call stable coins. They add a bit of stability. Um, they add a bit more of what some of us might want to call intrinsic value. So these types of commodity backed coins, I think they're good. I think they do have a place. Rolf Steiner, yes, Germans have historic memory as the people of the 1920s. Germany has had a share of ups and downs. I mean, they Germans do know what hyperinflation is. They know what it is, and they know the value of gold and silver. Again, surely everybody knows the price, but not everyone knows the true reasons, the true values of gold and silver. And again, it's for wealth protection. You need that wealth protection. You need something that's going to hold the value of your life savings. Perhaps you need to have that gold and that silver. Let's see. Let me go down a bit more and let's take a look at a few more comments, and then I'll be heading out. Um, let's see. There's not enough wildlife in 340 million people. Uh, that's a good one, Nick. Um, that's a good one. That's something I think each person would need to take a look at on their own on a personal level. Yeah, good point. Um, American Rebel 27 SBTV is what persuaded me to start investing in PM. American Rebel, you're awoke, and once people awaken, then they start to see again other people who are awoke are awake anyway, and they start to see that, you know, when some people laugh at you, why are you buying gold, silver, this, that, there's a better investment here, there, should have went crypto, this, that. The thing is, what they don't understand is that's from your point of view. That's correct in your eyes. In my eyes, what I see is I need some type of insurance. I can clearly see what's going on in the world. Went over some charts today. We showed we looks like we are in that liquidity trap. Liquidity trap was something that happened in Japan, and it's why Japan is, or part of why Japan is where it is today. And so we get things like the gold and the silver, and we understand, hey, I'm doing it because I need my insurance. And I say this before, you have auto insurance, yep. Home insurance, yes. Health insurance, life insurance, you have all of these insurance, yeah. Why do you get it? You pay for these insurance because if something should happen, you want to know that you'll be okay later on. Well, money insurance. This is why people buy gold and silver, because if in case something should happen with the financial system, they have an out. They have one foot in, one foot out, and that one foot out is definitely going to help them. And the best part about gold and silver, not the best part, but one of the other things is, if let's say nothing happens and you think things are okay, it's liquid. It's so liquid that you can go back into fiat and reinvest if you want. And hopefully gold and silver went up from the time you bought it. And that's the beautiful thing about gold and silver. It's a no brainer. I mean, try and get your auto insurance back, your money. If you never got into an accident, go and get your money back. If your home never burnt down, try and tell your insurance company, give you your money back. You're not going to get it back. Gold and silver, you can easily go back into fiat if you want. If you feel you want to reinvest, you can do that. And that's one of the other reasons why I would suggest to any of you who are storing gold and silver that, hang on, one more thing here real quick, that you should definitely look at our peer-to-peer programs. Peer-to-peer programs, what it is when you store with us, you can use your gold and silver as collateral, meaning you can go ahead, take out a low interest peer-to-peer secured loan and reinvest your funds. And we have a lot of guys that do this. For instance, this guy wants to borrow 1 month. He's asking if anybody will loan him $10,000 for 1 month at 2%. So he wants to know if anyone will do that. And we have people who have money. You look at this guy, he's willing to lend $60,000 at 2.25%, $186,000 at 3%. We have people willing to lend money. Why? Because they're probably getting a better return lending money here than they would be getting from a bank. This guy here, the borrowing request, instead of letting his gold and silver sit in a vault, he can bring it back to life and he can use that gold and silver as collateral and go ahead and buy more if he wants, or take that money and reinvest if he wants. So, this is a program that we've had for years. It's been very successful. And I mean, as you can see here, this guy is asking 6 month. Well, this is Singapore dollars. Singapore dollar as an example. He's asking if he can get 46,000, borrow it for 6 months. He's willing to pay 3.5% interest. Right now, there's nobody that can match this guy's borrowing request. So if you got extra money under your mattress, open up an account, and if you can, get it in Sing dollar. Better yet, if you're here in Singapore, use those Sing dollars. You can go ahead and fulfill this guy's borrowing request. 6 months, 3.5%. You can fulfill it, and you probably get more than what the bank would give you. Again, this is per annum though, just so we're all clear about that. So, gold and silver, it's more than just the price. It's a store of wealth, and with us, you can use it as collateral through our peer-to-peer secured loan program. So, I hope you guys take a look at that, and it's pretty interesting, and it's something that can work. I know for a lot of you. Okay, and so with that, uh, global citizen. I saw a global citizen there. We had the pleasure of meeting a lot of people from the. They were from Germany. They were part of this global citizen group. We had the pleasure of meeting a lot of them. They came down to Singapore. They went through a few presentations, and they were invited in the vault, and they went through the vault, and they had a chance to see that this is all real. When you buy it, it's yours. It's definitely yours, and it stays there in your name. It's it belongs to you. You own it. And so again, we're glad they had a chance to see that. So take a look at a few more comments, and then I'll be heading out. Let's see. Let's see. P2P, I was not familiar. Thank you, LC. LC, sure. If you have questions about that, just send us an email at sales at silverbullion.com, and you can ask us about. Hang on, let me type it in for you. Okay, yeah, sorry about that. So that one there, sales at silverbullion.com.sg. If you got any questions, I mean, just go ahead and ask us, because the P2P or peer-to-peer secured loan lending program, it makes a lot of sense. A lot of people do it. Um, it a lot of people take advantage of it, and that's one of the good things, where because that silver and gold is so liquid, it can be used as collateral. So, but to be clear, this is not a gold leasing program. This is actually where you own physical gold and silver. You're storing it in the vault with us. We know it's really gold, really silver. We've tested it, and so now we're able to allow or stand behind it, where someone else may decide, if you need a loan, they'll go ahead and give you a loan, because they know that your gold and silver is real. And again, this is the program. I think it's very unique to us, and it's a big reason why a lot of guys from the U.S., besides Singapore's jurisdiction, why a lot of guys from the U.S., Europe, Germany, as we just had last week, why they come and feel confident that their items are safe with us, and there's things that they can also do with it beside it just sitting there. They can go ahead and reinvest with using the peer-to-peer secured loan program. Okay, so with that, I think that's about it. Um, Again, I appreciate you guys being here, and just try your try your best to dig into things and see what's going on. It seems that the world we live in today is just full of icebergs. All we see or hear is just the tip of the iceberg, but there's a whole lot more beneath it. And unfortunately, we're in a time right now where we have to take a deep dive and see what the rest of that iceberg is showing or telling. So I'm glad, I think I got the smartest bunch of people here. Um, I'm glad that you guys all are awoke. I'm glad that you folks share it with your families and your friends, the things that you know. And the fundamentals are there, for silver and gold. Fundamentals are there, platinum, palladium. It's just the timing, with the Fed consistently having new tools, as what we just talked about. They can continually kick the can down the road till that road ends. And that road, where's it going to end? Is it going to be market crash, or is it going to be another country coming up with a new currency? We have to really broaden our horizons, and it's a big world out there, and people have different needs and plans. So just always be aware of that. It's not always the way we see it. It's the way other people may see it, and we have to accommodate towards those things. Anyway, silver and gold, again, wealth protection items. I think that's really where we need to be, wealth protection. Egon von Greers is going to be coming up later on this week, I believe. So we'll have a good chat with the Egon. He's always a good guy to talk to. But again, you guys take care, and let me see. Patrick, keep it coming. We're headed into wait a minute, huh? Jeez, gotta have some. I promise I'll have one show that's 100% positive and smiles and rose-colored glasses one day, but today's not the day. Anyway, you guys take care, and again, always just pay attention to what's going on around you, and as always, saddle up for what's coming ahead, because it's definitely going to be a giddy up, that's for sure, when things start going. So saddle up for what's coming ahead, and definitely silver up. Be a blessing, not a burden. You guys all take care of each other. We'll see you. Take care.